Hello, everyone, and welcome to our webinar on trends and best practices for managing OPEB liabilities. My name is Charlie Francis. I'm a retired city finance director following a 40-plus year career, all in local government finance. I've always been on the forefront of addressing pension and OPEB liabilities and costs. And in fact, my city was the first city in the nation to adopt an IRS-approved Section 115 trust for pension pre-funding that you learned about in the previous session. And I'm going to be your moderator for today's session. We have an exciting lineup of speakers, and I'm really pleased for them to introduce themselves to you. Tom, can you give us a brief description of your background?
Absolutely. Plymouth County Treasurer Tom O'Brien, here in Plymouth County, Massachusetts. I've been the Plymouth County Treasurer now for 17 years. Prior to that, I served in the Massachusetts House of Representatives for 10 years as a state representative for the 12th Plymouth District.
All right, thank you. I'm really looking forward to hearing what you have to say today. Andrew, brief description of your background.
Sure, Charlie. My name is Andrew Brown, Portfolio Manager with Highmark Capital Management. I have been a member of Highmark since 1997, Portfolio Manager since 2001, and from 2003 on, I've headed up a team of 5 portfolio managers within Highmark that work exclusively with PARs. Since 2007, though, I would say that really my main focus is working with the PARs clients on OPEB engagements, of which I think that it numbers about 175 to 200 clients to date. So it's my largest client segment of any mandate that I work with.
Okay, I remember working with you when I was with the city of Sausalito. So thank you for being here today. And Kate, can you give us a brief description of your background?
Hi, I'm glad to be joining all of you today. My name is Kate Canny. I am a senior manager with PARS, Public Agency Retirement Services. I work with our clients here on the East Coast with regards to Section 115 trusts. I work with agencies to help them address their unfunded liabilities and have the pleasure of working with all 3 of my co-panelists here today. So always enjoy working with them and getting to participate in an event like this.
What a great group we have. Thank you, Kate. So for our agenda today, I'm going to kick it off by kind of reviewing the current OPEB landscape. And then Kate's going to talk about presenting the options and best practices for managing your OPEB liabilities. After Kate, we're going to hear from Thomas O'Brien, who will present a client example from the Plymouth County OPEB Trust Program. And finally, we're going to hear from Andrew Brown, who will discuss OPEB investing. So as a reminder, we will have time for questions at the end of this presentation, but please feel free to submit questions as we present this webinar. We want to make this as interactive, as lively and entertaining and enjoyable for you and for us. And of course, the webinar is being recorded, and we'll be providing copies of the slide deck as well as the recording of this webinar afterwards. Well, let's dive into our first topic, the current OPEB landscape. I'll be discussing who is funding, who is not, and what we know from reports and studies. So as we all know, OPEB stands for Other Post-Employment Benefits, which typically include retiree healthcare, dental, and vision benefits. Many state and local governments, provide these benefits to their retired employees as part of their overall compensation package. Now, there was a recent report in 2020 from the Reason Foundation. It was called the Survey of State and Local Government Other Post-Employment Benefit Liabilities. My friend Mark Joffe had a team of people scrape annual comprehensive financial reports and get this data on what the unfunded liability was for the states and many, many local governments across the United States. The report highlights the significant financial challenges that OPEB liabilities are posing for many state and local governments. The $1.2 trillion unfunded just OPEB liability represents a significant burden on government budgets and could lead to budget shortfalls. It could lead to credit downgrades in the future. So how did we get here? The report provides a breakdown of the unfunded OPEB liability by state. Let's come this way. By many local governments. It provides recommendations for managing your OPEB liability. It emphasizes the importance of transparency and accountability. And so overall, it highlights the need for proactive management. Now, unlike pensions, where annual required contributions are required, many state and localities don't have to set up a Section 115 trust or a pension trust fund. They are strictly on a pay-as-you-go basis. And I guess if your revenues growth always matched your expenditure growth, that wouldn't be such a problem. But and then the ones that have set up trust funds, again, without a mandate or a requirement to set aside money into a Section 115 trust fund, can fall behind in their funding. So the OPEB liability is something that has to be addressed by each local government. Let's take a look at some more facts. A recent report from the Center for Retirement Research at Boston College said across the state, all the state, the counties, cities, and school districts, the average is 4.8%. That is really low. And this slide presents even more sickening reports on OPEB. It highlights that retiree healthcare liabilities are underfunded compared to pension liabilities. So now that I've set the stage, let's take a closer look at why OPEB funding is so important. Based on the Bureau of Labor Statistics CPI data from January 2014 through March that just came out a couple of days ago, the medical CPI year-over-year percentage has been increasing, and that on average over the past decade, healthcare inflation outpaced general inflation. Now I know that since February 2021, healthcare costs, general inflation has outpaced healthcare inflation, but on average, over time, healthcare costs have outpaced general inflation. And this is a concern for policymakers because it makes healthcare and health insurance more expensive over time, more expensive versus your revenue growth. So we need to do something to address that, or we'll run out of money to pay for essential services. So we'll need to, failure to properly fund these benefits can lead to significant financial challenges. And so since many governments are facing this, what we want to focus on right now is what can state and local governments do to address these challenges. So with that, let's move on to our next speaker, Kate, who will be presenting on options and best practices for managing OPEB liabilities. Kate will discuss pay-as-you-go versus pre-funding, how to analyze which is better for your agency, how much you need to contribute, where the funds come from, and what trends we are seeing from local governments to pay down OPEB liabilities. So with that, turn it over to you, Kate.
Thanks, Charlie. Next slide. So basically, what are you thinking of as an option to address that unfunded OPEB liability? Well, there are three approaches. One is to continue with what had historically been done, which is a pay-as-you-go. Make it a line item in your budget. You pay your retiree healthcare. The other, which became an approach that we see out there, is to set aside money in a general fund or stabilization account. Just start setting money aside. And then the third option, which is what we believe is the better, stronger option for agencies out there, would be to pre-fund that liability using an IRS Section 115 trust. Next slide, please. So why would you fund versus just sticking with the traditional historic approach of pay-as-you-go? Well, with GASB 45, we started to have to quantify those liabilities. They actually became that number we were looking at. And GASB 75, those assets were listed on our financial statements. So by pre-funding your OPEB assets, by putting them in a trust, those assets are now are on your financial statements, and they're considered an asset to be compared to the liability. When you place your assets in a trust, those assets can be diversified. You're no longer dealing with general fund investing, so that you have the opportunity for greater rates of return. You can actively address and impact favorably your credit rating. I've had clients where they have established an OPEB trust, have begun to fund, and when they've gone out to bond that school building project, they received a favorable bond rate because they are thinking about those unfunded liabilities and addressing them. You can hedge against inflation, as we've heard both today in these presentations. And when we turn on the news and we look at those news alerts, inflation is what we're all talking about. The numbers came out this week. So you can hedge against inflation, longer life expectancies, and potential baby boom retirement surges. You're allowing that the future taxpayers in your communities aren't taking over a significant and bearing a significant burden of the cost of retiree healthcare. And you can protect those assets from diversion for other uses. You can only spend $1 once, and I can tell probably in your special districts, your school districts, and your communities, everybody's vying for those dollars to be used for their projects and the operating fund. Next slide, please. So impediments to pre-funding. Well, first of all, knowledge. What does it mean to have an Opeb liability? Where are you looking? Do you understand it? And what does it mean to pre-fund, to set aside those assets to be used in the future to offset the cost? Legislation. Different states have different statutes in place that either allow you to pre-fund or not pre-fund. There are states out there that do not allow for pre-funding. There are also states that have limits on how you can invest those funds, fixed income investing only. Education, you are out there, you need to educate your decision makers. You as your finance team are going to your board, you would like to put assets aside in a trust, but guess what? Your capital budget committee is out there looking for a new fire truck, Park and Rec is looking for new ball fields. You need to be able to educate your decision makers that this is a vital thing to consider. Perceived cost. A lot of agencies are like, and that and lack of money. Well, we don't have a lot of assets to set aside. So what's the impact? Every dollar set aside does have a positive impact, especially if you're investing and are able to diversify your investments for a greater rate of return. And then sometimes people see this as a kick the can down the road. This is an issue for a long time ahead of me. Well, think about those liabilities in an important way. Your Opeb liability begins to accrue for your employee on their first day of employment. So when your employee is there earning that benefit down the road, your taxpayers today and tomorrow are looking at that as a liability. Next slide, please. So trust versus a reserve account. Well, we've been putting assets aside in a reserve account for years. Why would we change it? Well, an important thing is the ability to invest those assets and in a diversified manner. Here in Massachusetts, if your assets aren't in a Section 115 trust, if they aren't in a opportunity like that, you're limited to general fund accounting only. Also, you can only tailor your investments for short-term, not long-term uses. Assets in a general budget account are revocable as opposed to irrevocable. And I know some of you out there like, the word irrevocable is off-putting. It's a very important thing. You want to be able to safeguard these assets and not have them co-opted for other uses. Assets in a Section 115 trust for OPEB are irrevocable for anything but retiree healthcare. So you may access those funds for your retiree healthcare costs at any time. And then they are the option of having them protected by a corporate trustee. I think this is super vital here. You want to know that your assets are being held for the best interest of your beneficiaries, your retirees. And also your beneficiaries are your future retirees. Those are today's employees and tomorrow's employees. And you want to keep that promise and have those assets available to pay for that benefit. Next slide. Is your trust trustworthy? So I've worked with some agencies where they think by adopting a certain state statute or having a governing board bless having assets set aside that they have a trust, they have an Opeb trust. Well, key point, if there are no trust documents in place, you don't have a trust. It seems simple, but it obviously always isn't. You want to make sure your trust is compliant with GASB standards, the IRS, state standards, and federal rules. You want to make sure you're checking all those boxes. Your trust assets need to be held separately from any other general fund accounts. You don't want to be commingling it with your cemetery fund, your school funds, or your capital or stabilization funds. These trust funds assets needs to be held for the exclusive benefit of the employees and the beneficiaries. You want to check those GASB 45 requirements. Dedicated solely for retiree healthcare, check. Free from creditors, that means if you hit onto uncertain time, like maybe what we heard from the city of Detroit, those assets are held away from the ability to be accessed from creditors, and you want those assets to be irrevocable from anything but retiree healthcare. The key thing to note is when your trust exhausts its benefits required, you have no longer are needing to outpay retiree benefits, those assets can revert back to your town's general funds. And you're allowed to diversify your investments. This is a key thing, which allows you for greater rates of return. And when you hear from both Tom and Andrew, they'll tell you the importance of being able to diversify those investments. Next slide. So an investment policy, you're going to want to put one of those into place. And here are some things that you want to take into consideration. One is, what is your time horizon? What are you investing towards? Mostly, I'm finding my OPEB clients are thinking on a 30-year model, but they may be chewing stopgaps and checking in at 15 years. What is your funded status? Here in Massachusetts, many agencies are below the 15% funded, so they'll be developing their investment policies based on that. Do you have a funding plan? That is, where are you getting your assets from? Risk tolerance. Andrew's probably going to talk to you about that. How do you as an agency approach investment risk? I've heard, like, if we had no risk tolerance, we'd all be going into growth. We wouldn't worry about it. But these are public assets that we're investing, so we do need to be mindful. And risk tolerance also can impact your time horizon. Are you going to be taking assets out of this trust in 5 years, in 10 years, in 15 years, in 20 years? All that is going to impact on how you're investing them. What are your goals? Are your goals to be fully funded? Are your goals to offset fluctuations in rates? Things to all think about. And what are your roles and responsibilities? Next slide, please. Thank you. Where do you find the money for the trust? That's a big challenge we have out here and our agencies we work with. Oftentimes, we'll put a line item in a budget and put X number of dollars, and we think about that. Perhaps we look at for surplus funds at the end of the year. We look at our free cash or our unallocated resources before we give it to the turn back. Maybe we have revenue sources, perhaps a meals tax, a hotel tax. You have an enterprise fund. In Massachusetts here, we have a couple of communities that have benefited from casino taxes. There's a revenue that comes in that way. A common thing I'm seeing that's being used is surplus retiree healthcare costs. You budget X% for your retiree healthcare costs, yet you only spend 85% of that. Maybe the additional 15%, you allocate that into your OPEB trust. Or in the future, many states have deadlines for pensions to be fully funded. And these agencies are now putting into plan that once their pensions are fully funded, they're going to redirect that money because they've already trained their agencies to budget for that amount, retrain some or all of it into their OPEB trust, which is a really fantastic plan to put in place. Next slide. So some trends in trust. One thing is to approach an economies of scale, band together. Treasurer Brian's going to talk about that, which allows lower administrative burdens on individual agencies, lower fees, still have the local control and ease of use, but when you're pooling together, it allows for a diversified investment, which is an everybody wins scenario. Instead of piecemaking that together and going and putting the puzzle together, maybe an agency or group brings that together too. We have agencies in different states, Rhode Island, Massachusetts, what have you, who've developed multiple employer trusts and investment pools, and they benefit from the everybody comes together and all boats lift up with a rising tide. Bundling your pension with other providers, looking for an investment provider that manages both, that can be a good service for you. And then one thing that we talked about prior and PARS has been working on is a combination of an OPEB pension trust where you have one trust but two buckets and you can address your unfunded liabilities together. Next slide. Trends in funding. It's an interesting thing that the pay-as-you-go model is still hanging in there. A lot of agencies are still really thinking about that. They're starting to think, what do we move away from it? So they're putting together funding policies. An important thing to think about when you do a funding policy, and I read some great articles today, you want to make sure your funding policy is directing you towards achieving your goals, but also is something that you can indeed achieve. So you want it to be achievable, not aspirational. So an idea might be that you say, we're going to put $100,000 in a trust this time, and then maybe for the next couple of years, that's going to be our amount. And in year 4, we're going to increase that amount by 3%. So it's all in different ways. You may, as I said a few minutes ago, target a revenue source. You may do reserve funds and things like that. Next slide, please. So funding strategies, and we're working with that a lot. There is no one size fits all, and it would be really great if you could all put your ABC in, put this money in, and you're ready to go. That's a challenge that I bet the majority of you out there would say, we can't achieve that, and definitely couldn't achieve that every year. Well, an option could be to put your ABC in and then remove your pay-go. Definitely an option. You'll want to consider that when you're thinking about investment approaches. Perhaps you put the difference of the two. You take what is the difference of your actuarially determined contribution and your pay-go and pull that. You could put in a one-time lump sum and leave it to let it grow. Or you can do what the majority of our clients find is put in what is appropriate for your budget. It's important to have great goals, but you want to make sure that you can achieve this and access these assets. Slide, please.
Okay, a couple questions came in, and one of the questions might be good to address on this slide. And the question was, do we have an example of a funding policy? And as you just said, there's not a one size fits all. Maybe you could talk to us a little bit about how we help develop those funding policies.
So actually, it's a process that I really enjoy working with my agencies to do a deep dive on this. We put the trust in place, and then we start looking at what are their financial commitments and what do they have access to. And we start off small and we go bigger. The funding policy may be, we're going to put in a line item and commit a small dollar amount to get us kind of training the animal to pre-fund. I live in a town where we had a special article each year that we set aside $100,000, and town meeting voted that. So they started understanding we were approaching that. The next year we had the line item plus the surplus for the retiree healthcare. So it became a combination. Funding policies should be fluid and growing with your time in investments. So it's not going to be a static thing. I think this should be something that should be reviewed annually, and also understand that you may have the best of intentions of increasing your funding by 2% or 3% a year, and then think back to 2015 here in Massachusetts, where we had 126 inches of snow and everybody's street budget got blown out of the water. And so funding got a little shaky that way. So, but the idea of a funding policy or funding plan is, this is something you're going to aspire to do and work towards, but don't hamstring yourself.
Okay, great. Thank you. I'm going to save the first question until a little later.
Okay. And then an interesting approach that is being seen across the country, and PARS is proud to offer this to their clients, is where you can address unfunded liabilities of both pension and OPEB in a single Section 115 trust. Now, the assets are going into one trust, but they're held separately because they have different timeline horizons. They have different sources of what issues they're addressing. Your OPEB liability, that's probably your 30-year investment approach. That's what you're thinking of. You may be putting that in a bit of a different portfolio approach, whereas setting aside assets to address pension, rate fluctuations, et cetera, you may be managing that on a more short-term process. We're always excited to talk to people about that, and we'll be providing information on that as well. Thank you.
Okay, thanks, Kate. That was really an informative presentation on best practices for managing OPEB liabilities. Let's jump to this question. The question came from an audience member who's in Florida, where they have implicit OPEB liabilities. And the question is, what would be a funding strategy if you just had implicit liabilities?
Well, you could actually, implicit's a kind of an interesting approach, and we do work with clients to do that. One approach could be having the employees begin to set aside funds on their own, but then the agency itself could set aside some matching funds. It's a little bit of a different animal, but that could be an approach they could take.
Okay. Yeah, I'd like to maybe add to that is the optics of having something that's called an unfunded liability on the balance sheet. It's, we may be able to completely explain it away that it's implicit and doesn't have that great of an impact. On the other hand, that's hard to explain, and what the public normally focuses on in that word unfunded. So if we just set up a Section 115 trust, designate part of our general fund reserve to go into that for that unfunded liability, the optics of just addressing it is a positive for the local government. So, well, we learned a lot from you today about the pros and cons of pay-as-you-go versus pre-funding, how to analyze which approach is better, what trends we are seeing from local governments to pay down their OPEB liabilities. Thank you so much, Kate.
Thanks so much.
Yeah, next we're going to hear from Thomas O'Brien, who present a client example from the Plymouth County OPEB Trust Program. Tom?
Thank you, Charlie. First of all, thank you everyone for attending this session. And I want to thank PARS and GovInvest for hosting this as well. I'm excited to be here and talk about what we've done here in Plymouth County. I can't see everyone on the screen, but I'm told that not everyone here has actually been to Plymouth County yet. If you haven't, think Land of the Pilgrims, the Mayflower. We're very well known for our cranberries. And of course, on everyone's must-do list is come and see the Plymouth Rock. So if you haven't been to Plymouth County, make it a chance to come and see us and learn a little bit about your own history right here in this country. I will point out that we actually have the oldest recorded deed in the United States of America right here in Plymouth County. That makes sense if you think about it. So if you haven't traveled here, we'd love to have you. I talk about Plymouth County because if you're not familiar with it, you need to understand what we were faced with back in 2014, 2015, as we were dealing with OPEB. Plymouth County has 27 communities. Our largest is the city of Brockton with over 105,000 people. Our smallest is the town of Plimpton with 2,985 people, and we do keep track of each of them. And so we really have a diverse population. The total population of Plymouth County is a little over 520,000 people. And as the treasurer of Plymouth County, I'm tasked with addressing the needs of these 27 communities on a fairly regular basis. And if you could think back to 2014, not that long ago, and the concept of OPEB, other post-employment benefits, was really kind of the Wild West back then. People were beginning to hear about it because of Gatsby. They were hearing about it because the press was beginning to cover it. But a lot of us hadn't begun to think about funding it and hadn't developed a strategy. And in 2014, my 27 communities came together and asked me as the county treasurer to investigate what we might be able to do, what our current options were to fund OPEB liability, and was there perhaps a better idea. Back in 2014, here in the Commonwealth of Massachusetts, we really only had two options at the time. One, we could join the state fund, certainly a viable option certainly helpful. They do a great job. They had a very sophisticated portfolio. The rate of return was really robust. However, at the time, they had some minimum contribution requirements. They had some other hurdles to jump over in order to join. And it wasn't as great an option for all of our 27 communities. Of course, the other option was to create your own trust and invest your own portfolio. The downside to that, from my perspective, was that it was a lot of work. Many of our communities don't have a huge staff to begin to do that. We don't have the legal or technical expertise to begin to do that. And quite candidly, even as you recruited some sophisticated potential trustees, they weren't familiar with this type of long-term investing. And so there was administrative risk, legal risk, and what I like to call headline risk, which we really want to avoid. We don't want to be in the headlines. So I wasn't really happy with the two options. Doing it yourself didn't seem to be a great option. I was also concerned about access to investment strategies, ideas, and products, and also fees. Fees are higher if you're doing it on your own. So as a result of some research and a little bit of networking, which is always helpful, we found out about PARS and their partner US Bank, and that for years they had developed something called a multi-employer trust. We said, that seems like a pretty clever idea. We like it because it's bringing people together, effectuating economies of scale, which not only provided us better access to investment ideas and products, but also helped to drive down fees. What I found great about our partnership with PARS and with US Bank is that they realized that over an investing timeline that we have here, which is really 20, 30, or 40 years, we can't make the mistake of thinking this is short-term investing. This is long-term investing. One of the things we can control are the fees. And while reducing fees by maybe 10 bips or 20 basis points doesn't seem like a lot, think about that over 20 or 30 or 40 or 50 years. So one thing we can control are the fees that we pay or don't pay, and we can help earn more as a result of paying lower fees. So I was excited about this. I developed the concept and brought it to our Plymouth County commissioners to create the Plymouth County OPEB Trust, which we fondly call PCOT, and said, let's provide this as a resource to our 27 communities. They were fully on board. And as we were vetting the concept and the idea, some of my other treasurer friends in Bristol County, Barnstable County, and Norfolk County, and think of a little bit north of Plymouth, think a little bit of southwest of Plymouth, and think of the Cape, approached us and said, if you create this, would you allow governmental entities in these other counties to join? And our commissioner said, absolutely. And so on January 15, 2015, and I like to choose dates I can remember, just so that everyone here knows, I got married on January 1st, 2010, so 1/1/10. And on January 15, 2015, we created the Plymouth County OPEB Trust. Can't forget the date. And we were very excited about what we had put together. We had established a multi-employer trust to serve 27 communities in Plymouth County, plus all the other governmental agencies in the other 3 counties, with a resource that they couldn't get on their own. The other thing we did was made sure that there were no hurdles to entry, that if you qualified as a governmental entity, you could join. We drove the fees down, and in fact, have driven the fees down at the state product because they realized their fees were incredibly high. And the one other, I think, clever component we added was that there was no cost to leave. So if we weren't meeting or performing to your expectations, you could leave. Obviously, there were some paperwork that needed to be done, but we wanted people to understand that we were long-term partners with them, with our governmental entities, and we wanted to be a resource. The great addition, the secret sauce of the Plymouth County OPEB Trust is the work really done by PARS, Public Agency Retirement Service. Because what they do is take care of all of that administrative work. They make sure that we have the proper trust documents in place. And it was surprising to me back in 2015, 2016, 2017, even as recently as last year, that some of our communities in those 4 counties didn't have proper trust documents. They thought they did. They were trying their best. They'd reached out to counsel who had pulled something up off of the internet and thought they had the right trust documents, but they didn't. However, the minute you join Plymouth County OPEB Trust, you have the right documents, you have administrative support, and through US Bank, you have a real access to some fantastic investment ideas, investment strategies. And so it's proven to be a wild success, I think, beyond our dreams, our expectations, and our imagination. I think when we were starting back on January 15, 2015, we thought by today, here in 2023 rather, we might have maybe 15 or 17 member units. We thought that we might have probably about 15 million in assets under management, because we don't have a marketing tool. We don't have brick and mortar stores. The only way we have groups join us is largely through word of mouth and hearing about the success that has become the Plymouth County OPEB Trust Program. And I'm going to ask the administrator to move forward 2 slides, and then we'll come back one, just so that you can see that the program has exceeded what we expected. I'd mentioned that we weren't expecting to be where we are, but as of March 31st, 2023, we have 32 member units, almost double what we were expecting. And we have $40 million in assets under management. Again, almost double what we were expecting at this time. And the success of this program has been, we're a full service, turnkey operation that invests for the long term and quite candidly drives down fees. You'll see that little note there in the slide that our members have had their fees reduced 25% since inception. And as we continue to grow the assets collectively, those fees continue to come down. It was a unique model. It was well received by our members and was really a way for us to increase value for our member units. Another interesting little note is that we retain local control. We have an investment committee made up of our members so that they have a say, not only in the investment, but the direction of the OPEB Trust. And we heard from our members in 2017, 2018, 2019, that the product we had, while a great product and an aggressive product, again, we're investing a long-term horizon here. You want to be more aggressive. They asked if we could offer different options. And the team at PARS, the team at US Bank definitely worked together. We provided additional strategies, some a little more conservative, believe it or not, one a little bit more aggressive, so that our members had different choices that they could make. Perhaps not surprisingly to me, everyone has remained in the same strategy we originally created, although we did have one member that's fully funded go into a more conservative strategy, which makes perfect sense once you become fully funded. But the team have really generated quite a success story here. And it's just one example of what you can do. I know that the folks on this session are from around the country and are exploring their own options or thinking about what they might be able to do. But I would suggest perhaps that if you haven't thought of a multi-employer trust as a potential vehicle, that it might work for you, especially if you're a smaller size community or if you don't have the resources to dedicate to this. Why not put together a team and utilize their expertise? And that's what we've been able to do here in Plymouth County, land of the Pilgrims, home of the Mayflower, the place that I'm encouraging everyone to come and visit at some point in time. I want to go back just one slide, Charlie, if I could, to talk about a few other things and then turn it over to Andrew, who I'm excited to hear from. So I certainly don't want to take up any of his time. You've seen the growth of the program over the last 8 years. I wanted to just highlight that third question about how our members are addressing the current investment climate. And the answer is calmly, coolly, in a manner that we hope that long-term investors respond. Because of the team we put together, we're able to, during volatile markets, which we've all seen. I mean, think about last month. Think about the month of March. We had a bank failure. We had inflation higher than expected. We had the Fed Reserve continue to increase interest rates. And yet our collective membership continues to invest long-term, dollar cost averaging in, and not reacting to the volatile market. Because one thing you don't want to do, and you've heard this before and you'll hear it again, is miss the good times in the equities market. You want to be there when the market will rebound. And I will tell you what, here's what we know. The market is cyclical. It will go up, it will go down. Here's the other thing we know. I can't tell you when that's going to happen. And anybody that says they can is not telling you the truth. We just don't know when the market's going to go up or when it's going to go down. But we do know for the long term, you're better off being in the market than trying to time the market. So our members are very strategic and just continue to invest as much as they can. The last question is, where's the money coming from? I think Kate did a terrific job highlighting some of those points. And I can say that our members are doing those things. If they have a budget for health insurance and the budget was lower or the cost was lower than expected, they'll take that differential and put it into their OPEB trust. Makes sense, doesn't it? Because it's health insurance related. So you're certainly dedicating a resource, a finite resource, in a manner that the body, whether it be your local community or your boards or your council, was expecting. Another thing that we've seen here, legal settlements. The Commonwealth of Massachusetts has had a number of legal settlements over the last year or so, bringing money back to our communities. That's resulted in some resources. We certainly suggest a good place to put those one-time resources is into your OPEB trust. Of course, we're hoping you're with PCOT, but whatever your OPEB trust is, it's a good place to put those assets. So those are just a few thoughts. I could talk ad nauseum about Plymouth County OPEB Trust and some of the things we're doing, but I'm anxious to hear from Andrew and potentially answer any questions at the end. Thank you again for including me. I thoroughly enjoyed the chance to talk about the Plymouth County OPEB Trust.
Thank you, Thomas. We really enjoyed hearing from you as well about your experience, about how the program was set up, how it's been successful, and the benefits it provided to the county. So finally, we're going to turn this over to Andrew Brown, who will not be discussing when the market goes up and when the market goes down, but he will discuss OPEB investing, including the short to medium term investment climate, whether agencies should invest or continue to invest, and what are other agencies doing. So with that, I'm going to advance the slides and come over to Andrew.
Good grief. Who needs Andrew Brown when you have Thomas O'Brien laying out the law? That was a good summary, and probably a few sound bites that I'll be offering up in a second. Charlie, go to the next slide, please.
Okay, and Andrew, do you want to turn on your video?
It is on, I think. I have both a video and an audio feed. The audio feed's through my cell phone, and the video is through the laptop.
All right, we're just not seeing your face.
Oh, okay. All right, I'm sorry. So let me start with, in terms of the current investment climate, I'll just give you a quick thumbnail sketch of our economic forecast for 2023. And then I'll, right, that slide, please. And I'll start with the headline. And from our vantage point, we believe that we're going to see a small recession in 2023. And you can kind of gather that from the first line item, GDP, minus 0.5 to a plus 0.5% forecast range. So, I guess that plus 0.5% indicates that it's not set in stone from our standpoint that we're going to have a recession, but by and large, 8 out of the 10 members of our asset allocation committee would put our initials next to the minus 0.5% side of that range. And the reason why, first and foremost, why we think we're going to have a recession is the Federal Reserve last year raised rates from 0 to 4.25% on the Fed funds. And typically when the Fed raises rates, it takes 9, 12, 18 months for that type of impact to filter through to the economy. And we're basically right at that point where interest rate hikes from last year are going to start to slow the economy. So from where we sit, we think we're going to have a small recession this year. And then with that small recession, yeah, all the things that you would expect to see happen, we think will. Corporate earnings we see going down 8 to 10%. You can see our number 195 to 205 there. Unemployment, we would expect to spike up. Right now, unemployment's at 3.5%. We see that going up to 4.4 to 5.1% level at the end of the year. Core PCE inflation, which is the inflation gauge that the Fed uses when they're making their Fed funds policy. Right now, core PCE is at 4.6%. We see that ticking down to a 2.9 to 3.4% level at the end of this year. And finally, putting it all together in terms of what the Fed might do going forward, we see that the Fed will possibly hike one more time, and then the next meeting is May 3rd. And from our standpoint, they will hike at that May meeting, but then they very well could be done. And in fact, if we are wrong on our recession forecast, and in other words, if it's a little bit more dire than a minus 0.5% decline, or if the banking crisis, for lack of a better term, we'll call it a crisis, if the banking situation, maybe a better way of putting it, takes a leg downward, yeah, the Fed very well might be in a position to cut rates more quickly than maybe what a lot of people out there think. So small summary, 2023, modest recession ahead of us. Next page. If we're going to talk about the current investment climate, we really have to start with inflation. And inflation obviously is important. It impacts me, it impacts you as consumers, but it has been the focal point of the Federal Reserve's interest rate hiking campaign from last year. And so what I've done is I brought a slide from our friends at JP Morgan that track a 50-year history of inflation. And so you'll look at the blue line on this exhibit. The blue line represents headline CPI, which CPI stands for Consumer Price Index, which is it's an index gauge of a variation of prices that consumers pay for goods and services. You'll see the dark line on this exhibit as well. Core CPI, which backs out food and energy, which are two maybe more volatile components of the price index. And if you look at the table insert at the top of the page, you can see the 50-year on average on an annual basis, either core or headline, goes up about 4%. And so a couple things that I want you to take from this exhibit. The far right-hand column shows the most recent experience over the last 12, 15, 18 months. And you can see whether you're looking at the blue line or the black line, inflation has been at accelerated levels that really, you got to go back to the 70s to find a period of time where inflation has spiked so significantly. The second point I would make, and I don't know if you can see it within the nuance of your computer screen, but there's shaded regions on this exhibit. And those shaded regions correspond to periods where we've seen a recession over the last 50 years. And, kind of long story short, whenever you've seen inflation spike up over 5%, it has been commensurate with some type of recessionary period. And with last year, June, 9.3% CPI reading on headline inflation, we think that would corroborate our call on a modest recession this year. Charlie, if you could turn the page. Yeah, and so maybe a little bit more deeper dive in terms of the Fed as well as interest rate policy. This exhibit charts a little bit over a 20-year history of the Fed funds interest rate policy. Your y-axis is going to be interest rate levels, and your x-axis is going to be calendar year periods of time. And you can see from the line chart there at the bottom that, when the economy, the market has a significant event, the Fed has been there to significantly cut interest rates, be it, as you kind of go from left to right on your screen, the dot-com bubble bursting there in 2000, the great financial crisis of 2008, and certainly not the pandemic, but yeah, those 2 periods of time, you've seen the Fed have your back, cut interest rates. And then the crisis averts, you get back to maybe more of a steady state. And then the Fed resumes maybe more of a hiking campaign. But when the Fed is hiked, be it 2003 to 2007, or back to 2015 to 2018, they do it in a very steady, slow, methodical manner. 25 basis points here, 25 basis points there, nothing to really shock the economy or shock the market. That was not the case last year. You look at 2022 and it's almost a perpendicular line emanating from the x-axis. You know, the Fed was hiking rates 50 basis points at this meeting, 75 basis points at the next meeting, 75 basis points at the next meeting, all to fight the significantly and elevated levels of inflation. And so it begs the question, okay, well, where do they go from this point on? And to maybe kind of get a glimmer into the future, look at the far right-hand column of this exhibit. You'll see 2 color-coded diamond forecasts, if you will. The blue diamonds represents the internal Federal Reserve's forecast of interest rate policy over the next 2 years. And from their standpoint, you can see that they think that maybe they have 1 hike left in them. So they see Fed funds peaking out at a 5.1% level. And then gradually, end of 2023, maybe at a 4.3% level, end of 25, maybe at a 3.25% level. So gradually decreasing level of interest rates based on what the Fed thinks. And then you see the green colored diamonds, which is the market. And the market in this case is the Fed funds futures contract, which the market says, Fed, you're probably going to be cutting rates 2 to 3 times this year, taking it down to a 4.35% level at the end of this year. And if you think you're going to get to a 3.28% level at the end of 2025, no, we think you're going to be getting to that level at the end of 2024. The market's looking at a 3.29% level. So there's definitely a disconnect between the market and what the Fed is forecasting in terms of interest rates. Next page, please, Charlie. And so the Fed aggressively hiked interest rates last year, and it led to a historic sell-off in the bond market. And I brought this slide along to just put that into proper context. And so what we see here is almost a 50-year run rate for the Bloomberg US Aggregate Index annual returns. And so if you're a fixed income investor, predominantly a pension investor, this is the index that you're going to use for your intermediate term fixed income benchmark targets. And you can see from the black bar charts here that, more often than not, you invest in bonds, you make a little bit of money. And in fact, the headline for this exhibit at the top of the page really could be, would be, should be the main takeaway on this. 42 out of the last 47 years, if you're invested in bonds, you made some money, generated a positive return. And even in those years when you didn't, you're down 1 or 2%, maybe 3% at worst. And then you look at 2022, down 13% in terms of fixed income investing in the calendar year last year. And obviously, this is a function of 2 things. One, the Fed raised rates 4.25% from 0% level, and that put a headwind on prices. But also, think about it. The bonds that you owned in your portfolio really weren't generating much in the way of income. So you put those 2 things together, and you had a significant sell-off in the bond market. Now, of course, we're not only investing in bonds when we build a portfolio, we're investing in stocks. And so, Charlie, if you could turn to the next page, it begs the question, okay, well, a 60-40 portfolio, how did that fare last year? So in this case, 60% would represent equities, but it's going to be only the S&P 500. And then the 40% would be intermediate term fixed income with the Bloomberg Ag Index that we just looked at. So going to the far right-hand column of this exhibit, minus 16%. This exhibit captures a 72-year history of 60-40 investing. And this is the 3rd worst calendar year period of time that a 60-40 investor would have experienced, trumped only by Great Financial Crisis, minus 20%. And in 1974, you're down minus 17%. So make no mistake, the last 12 months has been a very, it's been a historical one for the record books, but for all the wrong records that you don't want to break, right? And so really, in terms of a current climate on investing, those were the main exhibits that I wanted to present to you. And then sort of maybe as a summary, or really over the last couple of days, I've been thinking about summarizing these slides and maybe the experience that the listener has had or maybe had to endure, right, as I go through some of these exhibits. And I think about it from your standpoint, what did I say? Well, hey, we didn't have a recession last year. We're probably going to have one this year. We didn't have a recession last year, but the bond market was, worst bond market ever. 60-40 was your third worst 60-40 experience, over a long period of time. And inflation, while it's still, was in that chart that I showed, just coming down a little bit, it's still running pretty hot. I mean, yesterday's CPI was 5%. So we're still a ways away from the level that the Fed wants. And so when I think about that, I can't imagine that the listener on the other side of this call is saying, let's go OPEB. I'm all fired up for some OPEB. But this is where, then I put on my portfolio manager hat. And we kind of go through those dynamics that Kate shared in her slide about formulating the investment policy statement, and maybe even some of the things that Tom touched on in his presentation and in his summary on the presentation. These are 20 to 30 year liabilities, long-term liabilities. You do not need these assets next year or even the year after. You need them over a multi-decade period of time, but you can withstand volatility. And so because these are long-term liabilities, I would encourage you to not do anything different with your plan if you've already started your plan. And if you are contemplating initiating a plan, this very well could be a pretty good time to start that. And if you think about all those little negatives that I shared with you a second ago, we might see a recession this year. And typically in a recession, your stocks go down 15, 20, sometimes 25%. But guess what? The S&P 500 went down 18% last year. And not all of that, but some of that is discounting slower economic activity that we're going to see maybe in 2023 and 2024. So don't let that totally dissuade you. Oh, and that worst bond market ever. Guess where that landed us? It landed us in a fixed income environment where corporate bonds can get you 5% for intermediate term horizons. Between 2 and 10 years on the Treasury yield curve, you're looking at roughly 3.5% or more. So not all the things that were so negative about 2022 necessarily will be felt here in 2023, 2024. And if they are, we have a multi-decade period of time to regroup, continue to put your contributions in, and that's what happens over a 20 to 30 year period of time. And if you think about the last 20 to 30 years, I mean, what do we see? We've seen a pandemic. We've seen a great financial crisis. We've seen the dot-com bubble bursting. We've seen Ukraine, Russia. We've seen a Desert Storm 3, Desert Storm 2. We see things that impact the market, but typically the stock market over the long haul does resume an upward path, showing gains. And I would not have near-term events dissuade you from long-term fundamental investing.
Okay. Thank you, Andrew. It really was an insightful presentation on OPEB investing and short-term and medium-term investment climate and benefits. So we're coming up on top of the hour. That concludes our presentation for today. We didn't have any additional questions come in. So I'm just going to thank the panelists for your sharing your valuable insights today. I want to thank PARS and GovInvest for sponsoring this webinar today. And finally, I want to thank you, our audience, for participating and engaging in the discussion. Your questions, comments have helped to make it a really informing webinar, a very much success. So thank you all and have a great day.